All right, welcome everyone. This is You Know Who, David Morgan, and I will say, a special guest, Mike Maloney. Mike and I have a pretty long history. Mike has been on the precious metals situation for a very long time, and he's done an excellent job all the way along, and I have to publicly compliment him on doing the Hidden Secrets of Money. I think that's probably one of the best series in the monetary space, not only in modern times, probably for quite some time. In fact, I don't think there's anything that's equal to it. Mike, welcome for an interview.
Well, thank you very much. That was a pretty flattering introduction, and I hope I can live up to all the hype.
Well, I'll tell you, you sent me your latest book, and folks, I'm going to be looking down from time to time. I made some notes in the book so I could interview Mike, but this is your latest.
Yep.
And the title is The Great Gold and Silver Rush of the 21st Century. So my first question, Mike, is why? Why did you write this book? I mean, you'd already written a book on gold and silver that's a bestseller. What compelled you to write this one?
Well, the old book is a little bit dated at this time. It still is the best-selling book on investing in precious metals, but there was a whole bunch that was cut from that book, and some of those concepts and so on did end up in this book. And there was also so much other information. The other book is some monetary history and how it keeps on repeating. It's some simple economics, the current state of the global economy, and then how to invest in gold and silver. This book is about all of the factors that will drive the gold and silver price far, far higher. I didn't get to cover that in the last book, and so this is the reasons why the great gold and silver rush of the 21st century is absolutely going to take your breath away, as I say at the end of chapter 7.
Well done. And I will admit, it's my own subjectivity, but I actually like this book better than the other one. To me, and I hate to say it reminds me of me, but it sort of does, because I write from an engineering perspective. So there's like no fluff, fact, maybe a comment or two, fact, comment or two. That's how I see this book after I read it. I really was impressed. So let's get into it. There's a few notes I made. The first 6 chapters are very good. Let's talk about one that I've been mentioning for a very long time, and that's on page 77, it looks like, and that's bonds, the super bubble.
Yeah. And it's actually the bondage market, and it's something that I won't participate in because, they're selling pieces of your future lifetime if you're investing in a sovereign bond. A corporate bond is fine. Corporate bond, they're borrowing currency from somebody and promising to pay them back plus interest, and that interest and payment comes out of profits that company is going to make in the future. That's what you're buying is a cash flow from their future work and profits. When somebody buys a U.S. Treasury or any sovereign debt, they're buying cash flow from future taxation, and that future taxation is extracted out of all of us with the threat of jail. And if you don't want to go to jail, you decide, no, I'm not going, and you barricade in your house, it's going to be at the point of a gun. And so really, they're selling off pieces of future lifetimes. And so it is analogous to the slave trade. People have to work in the future to pay back the principal and interest on the bonds that the Treasury is selling today. And so I just, right now, there's probably an opportunity in that market. Rates are high. The Fed is going to break something. And when they do, bonds will crash and there will be a profit. When they crash, they're crashing in yield, not price. The price on existing bonds goes way up then. And so there's probably a potential profit to be made, but I won't participate. But yes, the bond bubble. Let's talk about it.
So we've been in basically a 40-year bull market in bonds, and it just broke the major uptrend line recently. I forget the exact date. And, I made a mistake of, being a precious metals head when I was young, teenager. And then when it got to 1980, gold peaked. I think I've told this before, on my exact birthday. That was the all-time peak. So I think I'm in the right business. But regardless, I did sell some of my gold at 700, not the 850 peak. But the best thing you could have done, I was resistant to, which means sell your gold and go into the long bond at whatever it was, 17%, and hold it for 30 years or more, actually 40 now, and watch interest rates come down and down and down, which means bond prices go up and up and up while you're enjoying a 17% coupon. What could be better? I mean, that was it. But now we're in a different situation. The uptrend line has been pierced. And what do you see for the future of the sovereign bond market?
I see some wild swings. I see the Federal Reserve and the Treasury getting desperate and doing desperate things. So, this is a very unpredictable thing. And I'm really not an expert on bonds. It's something that buying debt just doesn't make that much sense to me. Debt as an investment. I'm going to buy somebody's debt. Well, even though this is a country, and it's supposed to be the richest and most powerful country on earth, and they do have the ability to extract taxes out of the population in the future to pay you your cash flow and your interest on that bond. It's still something that I've stayed away from. I just don't like the idea of investing in debt. And even though it's the U.S. government, it still requires a counterparty to perform for it to be worth something. And what I see is problems in currencies. You're seeing this right now, and this is one of the reasons that they've got to get us into central bank digital currencies as soon as possible, because if they have us all in central bank digital currencies and there are no other alternatives, then we can't go anywhere else. We can't abandon the dollar, even if it was going into a hyperinflation or something like that. It becomes very difficult to get out of a system, and they can just keep on extracting, because people don't realize inflation is a tax. It's a tax that has been put on you by the government they added 40% to the M2 currency supply since the pandemic. And then they're surprised that there's inflation. This just cracks me up. These are supposed to be some PhD economists, and they don't get that one. And they're going, well, there was no inflation from 2008 to 2020. And when we created all, this other $3 trillion or $4 trillion. And yes, there was inflation. There was inflation of asset prices only because of the process of how the Federal Reserve creates currency and where it has to go. The Federal Reserve Act handcuffs them to making purchases of U.S. securities or mortgage-backed securities, any security that pays interest and it's guaranteed by the U.S. government as to the principal and interest. And so that limits them to buying from the primary dealers, which are the biggest brokerage houses in the world, and they all have they deal direct in the treasury auctions, but they will also buy from private parties such as non-bank and other non-bank entities, pension funds, hedge funds, or you and I. If I was a bond investor and I wanted to sell, I don't know who is on the other side of that trade. It may be a primary dealer that is then going to sell my treasury to the Federal Reserve. And when they do that, currency is created, but it flows into the markets only. It does not flow into the retail sector, so it doesn't affect groceries and gasoline. But when you create a whole bunch of currency for the pandemic, give it to the Treasury, and they send us checks directly, that lit the fuse. And at the same time, the markets peaked. And as they go down, a bunch of people that have made a whole bunch of gains start cashing out. And as they cash out, that cash has to go somewhere. And if you look at what has happened since the pandemic to savings accounts, they've all exploded. And that is another form of inflation. I have an inflation measurement that I came up, and it was cut from my first book back in 2007. It was cut out. It's called CUP inflation, CUPP. It means currency units per person. And that is the best measurement of inflation that there is, because every dollar has to go somewhere, period. Every dollar created must go somewhere. So it's got to inflate either the stock markets, real estate, savings accounts, or consumer goods, or something else. There's something in society that has to inflate in price, when they create a dollar and inflate the currency supply. So from now on, I'm not going to call it inflation. I'm going to call it currency devaluation, because when they do this, they devalue the currency against some real good or service. The people may not see it as far as groceries and gasoline for quite some time because it inflated the stock market or it inflated real estate. But every dollar created must go somewhere. So the best measurement for inflation is currency units per person. And I could have fleshed this out a little bit more because it's currency units per person, I suppose, divided by the available goods and services in a society. But, it was an entertaining piece. I'm going to put it on ggsr21.com as some bonus material, because I was going to put it in this book. But again, I overwrote this book, and it was going to be like a $60 book if I had come out with it the way it was. And so what you see here is about 1 out of every 5 pages that existed. About 80% of the book, once again, was cut. And so we kept the best part. But at the last moment, like, I needed to cut more, and I was panicking because I can't sell it. If I came out with it at like $60, I only would have sold a few. And I'm going, what am I going to do? We got to cut this thing. And Dan Rubach, my editor and producer, came back with an edit called Mega Chop. And he cut chapters 3, which is an optional chapter. I didn't need chapter 3, but it's a very good chapter for people to read. It's a primer on reading charts and how charts can be used to lie to you. People really need to know what they're looking at when they look at a chart. And chapter 4, which is one of the most important chapters in the book. And anybody that's got the book should go and read chapter 4. But even if you don't have the book, chapters 3 and 4 are free. You can download them at ggsr21.com. And please email them to anyone you can, because it's really important right now for everyone to learn as much as they can about the global monetary system, how the financial world works, because we're getting conned and it is only going to get worse. I hate to inform everybody of that. And the only real protection that I see it's guaranteed. It is guaranteed. Gold and silver have a central bank guarantee. And the way it's guaranteed by the Federal Reserve is that they will never stop printing their currency. So as you print currency, it's devaluing the currency against real goods and services. And there's only two of those goods that are actually real money. So you can trade your currency for money if you wish. It's called buying gold and silver. But they are going to pump the price of gold and silver up to astronomical levels, I believe.
Well, I want to digress for a minute, because your cup is a very good situation to understand, inflation. But it brought to mind something from Bernard von Nothaus, who did the Liberty Dollar. And I don't want to digress too far, but I have to say it. So he called it fractional reserve accounting unit denomination. Fractional reserve accounting unit denomination, if you spell that out, it's fraud. So
it sounds like he was searching really hard for a great acronym.
Exactly, he did. So chapter 6, the point of no return, I just want to preface it slightly. My favorite 3-word moniker is all fiat fails. You wrote a whole chapter called The Point of No Return. Can you explain that further?
Well, yeah, it shows that the main thing that it shows when we get down to the very end of that chapter, the final chart in there really wraps up the whole thing. It shows the theft and this wealth transfer that is happening from the people to the biggest banks. And, first of all, throughout chapters leading up to that chapter, I explain the monetary system, how currency is created, and whenever you create currency, whenever you borrow to buy a house or a car, or you pay for dinner with a credit card, whenever a consumer borrows, the bank imagines currency into your account. They look at the asset, They look to see whether or not your credit is good and that you're going to pay them back. And then they imagine a number that matches the value of the portion of the asset that you want to take a loan out on. And they imagine that into your account. You then spend those units of currency, you pay the seller, and those units of currency are out in circulation. And this is where all bank credit comes from. It's all imaginary. And then the Federal Reserve creates currency by imagining dollars and buying something with them. Up until the crisis of '08, most of that was converted into vault cash. Most of the imagined digits that the Federal Reserve came up with were converted by the banks into vault cash, and that's the cash that's in circulation. So everything is imagined into existence, and the world is drowning in debt. I go through this list. I can't remember what page it's on, but in chapter 5, there is like 6 or 8 of the world's largest economies. And Hong Kong and Japan owe more than 6 years of their GDP. We, the US, owe 3.5 years of our GDP. So if everything that we create, all of the goods and services bought and sold in the United States, if 100% of the income was given to the government for given to whoever we owe this to for 3.5 years, we can pay off our debt. In the meantime, we have to starve to death because there's no food, there's no energy. Everything is being basically given over to these entities that we owe, but nobody asks the big question, the moral question: to whom do we owe? Yeah. And we owe this to entities that imagined this into existence. It's a pretty good hat trick, isn't it? It is. They get to imagine this into existence and put us in this bondage where we owe them the entire output of the United States of America for 3.5 years. So the world is drowning in debt. Now we've got all of these politicians like falling all over each other to try and give us more free crap. And they just passed this big spending bill where, you know, when people hear the words debt, deficit, and budget deficit, they don't realize that these are different things. The national debt is the cumulative real deficits, the deficits. The budget deficit is how much they plan at the beginning of each fiscal year to go into debt that year. But the real deficit always comes out higher. And if you don't believe me, just take the change in national debt each year and compare it to the budget deficit. And they make a budget and they plan on going, they plan a certain amount of deficit, how much deeper they're going to spend us into this pit of debt. And the real deficit at the end of the year is always higher than the one that they predicted at the beginning of the year. And it is significant. I did a study on this many years ago, and it was like $7 trillion way back in 2017 or 2018. Anyway, at the end, I made a chart, and I've got this really good spreadsheet guru chart guy, Alan Hibbard. And he did a chart. I asked him, for every dollar we borrow, how much growth do we get back in GDP? You know, is our borrowing being productive? Can we borrow our way out of debt? Which is a silly notion in the first place. But after World War II, we were actually able to do that. For every dollar we borrowed after World War II, we got back between $6 and $8 of growth of GDP. So if your GDP is growing faster than you're taking on debt, you can keep on borrowing, but your GDP is growing faster, so the economy gets bigger and you have more tax revenues next year than you have than you're going to spend. Hopefully you've got a budget surplus. But Alan Hibbard, this chart guru, you know, I joke in the book that you know, he's a guy that deals with numbers so high only dogs can hear them. Yeah,
I remember reading that.
That's a stolen line, actually, from the movie Tucker, a great film. But anyway, in the chart, it shows this constant downward trend. And we went below the zero line at 2008, and we haven't been able to get back above it. Now, when we borrow a dollar, we get between 30 cents and 50 cents back. And this is a recipe for disaster. It means that there is no way, we can't borrow our way out of this. It's just not possible anymore. Every dollar we borrow puts us deeper into debt. It's sinking the economy. And the politicians just don't realize this. They're not looking at the data. But that chart is the reason, because I say that the point of no return is the return or lack thereof. And what I was talking about was return on investment. Investment is in the United States is selling treasuries and borrowing so that we can grow the economy. Well, we're no longer growing the economy. For every dollar that we borrow, we shrink the economy by 50 cents compared to the amount of debt we're taking on. And we're at levels that, we're above levels experienced at the end of World War II. And this can't go on forever. So that is the point of no return, is that we are probably beyond that there is a crisis out there in the future, that there is no great solution that some politician can come up with. All they can do is make things worse at this point.
Great. I want to move back slightly because you make such profound points that are obvious to most precious metals investors, but and I know you've said it many times because I follow your work fairly closely, but I think there's three things that you say, and I want you to expand on it. One is currency and money, which I don't think we really need to talk about if anyone's followed your work, the difference. The other ones that really strike home is the amount of funny money that's out there compared to the 1970s bull market, and the availability for the general population to get into this market. I think those are the two keys that if we don't talk about anything else, we want the general public that's unfamiliar with metals and money and currency to understand. Can you please expand on that?
Yeah, well, that is what chapter 7 is about. It is the whole point of the book, and the other chapters leading up to it are so that you understand the current situation. When you get to the point where it's explained to you that in the bull market of the 70s, gold went up 25 times from its lowest intraday price to its highest intraday price. Silver went up 41 times from its lowest price to its highest price. And that was with a very, very small percentage of the planet participating to drive the price up. Now, there are about twice as many ounces of gold above ground, but in China under Mao and in the USSR, there were no investors, not one. There were no exchanges that you could buy gold on that would help to propel the price up. And it was illegal to own gold in the USSR or Mao's China. And most of the rest of the world, it was either illegal or there was some encumbrance, or the population was so poor that they were worried about what to eat tomorrow, how to get food tomorrow versus what to invest in. You remember this, all the commercials back in the 70s and 80s of starving children on TV in the Caribbean, Mexico, South America, Africa, Southeast Asia. It was all over the world, and it was true. There were children starving to death. And today, there are billionaires in all of those countries. And so the facts are that today there are 18 times more people that can buy precious metals than there was when gold hit its peak back in January of 1980. They have 55 times more currency. There are 56 times more millionaires. There are 200 times more billionaires. People don't know it, but there's countries in Africa that have like 6 or 8 billionaires in these countries. Same in South America, Southeast Asia. All these countries that were starving to death now have billionaires in them. There is 220 times more consumer credit available that people can buy gold and silver with. And the stock market, the global stock market capitalization is 49 times higher. And I believe the assets under management is, I think it was 39.6. I don't have that data right in front of me. It's not memorized yet, but it will be. But there's about twice as many ounces of gold available. Now, a lot of those things I just listed are the same people. A billionaire is the same guy that has some of those stocks that are 49 times greater stock market capitalization, and he's got bank accounts and so on. So not to double count anything, I take all of this data and distill it down, and I say there's no possible way of really coming out with a hard number here. So I'm just going to take a wild guess. There's probably about 50 times the amount of currency that can come chasing each ounce of gold, that the amount of ounces of gold and silver have doubled. There's 50 times more currency. Therefore, it's 25 times more currency per ounce that can come chasing gold and silver this time around. And gold went up 25 times and silver 41 times back in the 70s. Well, they had come off of years and years and years of price suppression by the fact that there was a face value on silver because it was our coinage, and the Bretton Woods system, which pegged gold at $45 per ounce of gold. This time around, we haven't had that price suppression, but we have had other price suppressions, and we've had this isn't in the book. This is in I think it is my number 2 or 3 reason. There's a video of the top 10 reasons I buy gold and silver. And in there, I show that there's this myth that in ancient Roman times, a man could buy a suit of clothes to clothe himself from head to toe, a toga, a belt, a nice pair of sandals. And it's always been that way. And that it's actually not true. It's varied in this price range. And in the Great Depression, an ounce of gold at $35 an ounce could buy you a very nice suit. But by the 1970s, at $35 an ounce, try and get a suit, shoes, and a belt in 1971, just before Nixon took us off of the Bretton Woods system, for $35, and you had to go to like some secondhand store to do that. So it's not the absolute truth, but there is some truth in that myth, in that it varies in this range. Sure. And right now, what we've had is all of these other financial assets. In ancient Roman times, there was one place to store your wealth, and that was gold and silver, the coinage that was in circulation. Now we've got bonds, and we've got stocks, and there's a multitude. We've got cryptocurrencies. There's a multitude of alternatives. And we have so much more stuff per person. It is just amazing, mind-boggling. The amount of stuff per person, the average person back in ancient Roman times was lucky if they had a good bed to sleep in and a pair of shoes to wear. Today, we've all got cell phones and refrigerators and multiple TVs, and it just goes on and on and on. Multiple cars. And so if some of those alternative financial assets come chasing gold and silver in a world where there's 25 times more currency per ounce of gold than there was in 1980 when it hit. It was actually $873 an ounce on, I can't remember which exchange that was, but that was an intraday high. And it just adds up to a mind-boggling potential for a future gold rush. And all it takes is the next big crisis to trigger the next great gold and silver rush. And I believe the Fed is like in the process of actively trying to trigger that right now. They may not know they're doing this, but they've raised rates at the fastest pace in history into all of the biggest bubbles in history. Chapter 5 was all, when you talked about bonds, that was the end of a list of all of the gigantic bubbles that exist and how big and how distorted the global economy is. And it's all the central bank's fault. When they create currency, wherever that currency flows to first goes into a bubble, but it's at the expense of the rest of the economy. That's the reason we didn't see inflation in retail prices, is energy was all being pulled over into the other assets. And so anyway, that's...
I want to pause you there, Mike, for a second. Reading chapter 7, and you went into the billionaire, and I forget the number. I know it's more than 2,000. Is it around 2,700 billionaires? I forget.
Yeah, I believe it's 2,755 billionaires, and even that was low. After the book was printed, WealthX came out with their estimate. It was just over 3,000 billionaires back.
Okay, so here's my point.
They listed a bunch that Forbes missed.
I want to make this point. I did it either in an article or a interview. I forget which, but my brain a little bit. I said, okay, how many real billionaires are there? So if we were back on the silver standard and you had a dollar, hasn't changed, is about 0.77 troy ounces. A lot of people think that a dollar is a troy ounce because the Treasury doesn't know what a dollar is, because they print,
and they don't know what a troy ounce is, right?
So they punch out a 1 ounce coin and put $1 on it, which is wrong. The dollar's a weight and it's not a full ounce. It's 77% of a full ounce. Point being this, there's roughly, and you get different numbers. You could take my number up or down. It's the idea that's correct. 4 billion ounces of silver. So how many dollars is that? We'll multiply it by 1.25. That's $5 billion weight of silver, which means you can only have 5 billionaires on the planet in terms of silver. That's it. Not 3,000. And I just thought that was fascinating, because I think I put on my Twitter feed, how many real billionaires are there? And I use that example. You could comment on that or not. We can move on. But it revivifies what we have both talked about, you more than me, is there's money and then there's everything else. And if you look at it in terms of money, there isn't a lot of it.
For your viewers, go to ggsr21.com and read and download chapter 3 of the book. And you'll see the difference between currency and money vividly portrayed as how many cans of Campbell's soup you can buy for a given quantity of currency. And before 1971, so from I believe it's from 1898 until 1971, it averaged, I used to give this presentation like back in 2010, 11, 12, something like that. And I'd be on stage and I'd bring up a frame that is just an empty chart with prices on the side and time across the bottom. And then I'd bring in a can of Campbell's soup, and the price would crawl in from 1898 at 10 cents per can. And then it would hit 1971, and I'd bring in a gold coin and draw a circle around it, a slash through it when Nixon took us off of gold. And then the line starts to rise, and it doubles again. And now it has doubled again. It's up at the top of the chart. So we've gone from 10 cents to about a $1.40 or $1.50 for a can of Campbell's soup. And I didn't realize back then, it was only until I was doing this book, and thank goodness I decided to, or Dan made the suggestion of putting chapters 3 and 4 online, because I had more time to work on it. Because after I was going to go to print with it, I realized, wow, this story that this chart is telling, because charts, this is part of a section called Every Picture Tells a Story, as Rod Stewart said. And it wasn't really done, because what I should have done is taken out the soup and the gold coin and stuff, and just taken that chart and flipped it, and then put the number of cans on the side instead of a price. And what is the price of $1? Well, from the grocer's perspective, it takes a certain amount of Campbell's soup for him to buy the $1 from you. Most people don't look at it this way. When somebody says buy or sell dollars, you do that every time that you buy something, you are selling dollars. When you work, you're buying dollars with your work. And so what's the price of $1? Well, the price of the $1 used to be 10 cans of soup until we went off of money, and now it's gone down and down and down. And currently, the price of $1 is 1/3 of a can of Campbell's tomato soup. That's the price of $1.
Very good.
So it's entertaining, and it shows there is a line there. And we go from the side where it's money to the side of fiat currency. And that is the difference. Fiat currency is borrowed into existence. It cannot possibly hold its value because it's borrowed into existence. When they borrow it into existence, they promise to pay interest, but we don't borrow the currency to pay that interest. Then we have to borrow it in the future and promise to pay that back with interest, which means it is not mathematically possible for the currency to hold its value. Now, I keep on saying currency because the definitions of money, the very first one is a store of value. Go to the Federal Reserve's website And that's what you'll see on the Fed's website. What is money? One, a store of value. And then it's a medium of exchange. It's portable, divisible, durable, and all that stuff. Along with currency. Currency shares those other attributes, but currency is not money. And if you're talking with somebody and they say, oh, no, the euro is money, or my US dollars are money, the yuan is money, the yen is money, baloney. Just if they say that, ask them, is there inflation? And if they say, well, yes, then say, aren't those two things mutually exclusive? If there is inflation, it means that the currency is losing value. If you buy something today and it costs you twice as much as it did last year, you're paying with currency, not money. You talked about real billionaires. That's measured in money. Yeah. No, there aren't all of those real billionaires. It's an illusion that is caused by currency.
There's a section in, I think it's chapter 7 or 8, that a little bit new to me. I kind of thought of it, but you did a very good job. It's called The Gift of Giffen. Can you explain that for our audience?
Wow. I'm glad you brought that up. And I think that comes right after The Shape of Fear. I show people a chart, and the charts of the S&P, and it's got these crashes with these nail-like spikes, like a knife, and then rounded tops. And it's a picture of emotion. I took the scales off of it and the dates, and I just show the shape of it. And you can see greed and then fear, panic, and greed and fear. And then I follow that up with the gift of Giffen. I can't remember, it was in the 1700s or 1800s. I think it was Sir Charles Giffen, but his last
1890.
1890. Okay. And he came up with this theory that there are certain goods that exist that violate the laws of supply and demand. When the price rises, people want more of them. The price rising doesn't limit on most goods, almost everything. If the price goes up too high, you seek a cheaper alternative. You don't buy as much of it because you can't afford as much of it. Conversely, if the price falls, it's on sale, so you buy a bunch of it. And that's the laws of supply and demand. But there are certain Giffen goods that violate those laws. And in my mind, gold and silver are the ultimate Giffen good. At first, they obey the supply of laws and the supply and demand laws. But like they are right now, we're in a trading range, and people. But when gold and silver start taking off, people start chasing price. Now, I'm a precious metals dealer, so I see this all the time. When the price is noodling sideways, we don't have much business at all. When the price starts taking off in one direction or another, suddenly we've got business. But like in late 1979, early 1980, gold and silver both turned into Giffen goods in that they kept on rising, and it didn't matter how much they rose, people wanted more of them. And they were starting to get worried about the economy and is the US dollar going to survive? It had only been a fiat currency for a few years at that point. And so the price kept on rising, causing more people to panic, causing more people to want to buy them. And what that causes is the people that do have it don't sell. Normally, they would be the sellers that create the supply. When the price is high, it draws a bunch of sellers into a market for most goods. But in this case, they're worried about the dollar as well. And so they don't sell. So suddenly there's less supply. The sellers disappear and everybody becomes buyers, and it's shooting for the moon. Now, it isn't in this book. I wrote some articles online about the Hunt brothers, and it was, I'm not supposed to say his name, but there's somebody that's an expert in the precious metals field, and he attacks me on stage and stuff. We agreed that we would not talk about each other anymore because he has attacked me many, many times, and some of it in public. And I made a rebuttal video, and I basically, I shouldn't say any more about that.
Okay. We can move on.
I interviewed him back in like 2004 or 5 at the Silver Summit, and he agreed with me. He said that the Hunt brothers only added 50 to 75 cents at the most to the silver price back in 1980. It was really the public switching their preference from gold to silver. Gold had become too expensive. You got to remember that it was $35 an ounce just 8 years earlier. It was $35 an ounce. Now it's approaching $8.50, or it's at $8.50. And so people were switching their preference. And when it broke 400, people started buying silver instead of gold because it was still cheap. And silver took off like a rocket and never looked back. And then it was the day before gold peaked. I believe that was a Friday. The COMEX put in position limits. They had done this twice to try and break the Hunt brothers. And then the markets opened up, and there was liquidation orders only. You know more about this
only
than
sell.
I do, actually. And with liquidation orders only, it means you can't open up a new futures contract. You can only close out old ones. This is a rule change that says the price, gold or silver's price cannot go up. It can only go down. It's a rule that COMEX put in saying the price can only go down. You can only close out contracts. You can't open up new ones. And so I believe that when they did that, if you looked at these trading pits back then on the Chicago Board of Trade, the Chicago Mercantile Exchange, you would have seen a big room with these circles of guys on the floor, all screaming out prices, holding up hand signals and stuff. And that was the trading going on back then. And there are something called pits. That's a circle of guys. This is the silver pit. Here's the gold pit. Do you think the traders in the gold pit did not hear about what happened to the silver guys? I think that, on their lunch breaks and in the restroom, there's nothing else that they could talk about. And then at the same time, there's also a bunch of investors that have both gold and silver. And so I believe that the gold guys are saying, well, if they can do that to the silver guys, we're next. And they all started selling. Yeah. I think that is what capped the price of gold. So I think the Hunt brothers aren't responsible for driving silver to $50. They're responsible for capping gold at $873. And the U.S. government, Paul Volcker, was in on some of these meetings with the Commodities Exchange. The U.S. government, the Federal Reserve, and the Commodities Exchange used the Hunt brothers as the scapegoats to save the U.S. dollar because gold was in a runaway. If gold's in a runaway, the U.S. dollar is in trouble.
Yeah, well said. Now let's move into the silver chapter. I forget the exact name of it, but the silver lining. So you did, I thought, a really good, broad-based, well-thought-out analysis of what price silver, right? So in this chapter, you talk about the CPI, the median home price, the Wilshire 500, Treasury bonds, a 10-year, the GDP of the U.S., currency in circulation, M2, and money of MZM, and you come out with an average. And can you just go through that? I don't need an exact number, but I like the way you did that because you kind of factored in everything that's out there that we consider to be, dare I say the M word, or could I just say currency or an asset?
Yeah, a financial asset or currency. Yeah, well, I started this currency versus money thing back when I was writing my first book. I realized, actually, I was on stage with Robert Kiyosaki. The first time Robert Kiyosaki introduced me to a large crowd, it was 5,000 people at the Los Angeles Convention Center. And he said, in 1971, the US dollar went from being money to being a currency. And here's Mike Maloney to tell you how. So he was talking about when Nixon took us off of Bretton Woods. And I went, bing!
Yeah, good.
Oh my God, this is right. And I've got to dig into this deeper. And there is a difference. And it is that a currency does not have to be a store of value. In fact, it cannot be a store of value over long periods of time, simply because if it starts to store value, it means we're going into a deflationary implosion. The currency supply always has to be diluted. There always has to be more loans being made than paid at any given time, because when you pay your loan, your mortgage, your car, that currency, when it hits the debt that's on the bank's books, vanishes. It's gone. So currency is always being created, and it's made and paid, created and extinguished constantly, and we keep on borrowing a little bit more, and that's the constant growth of the M2. But getting back to all of those things, I wanted to know, what would gold's price, it's silver here, what would silver's price have to be if it went into the same bubble that it was in 1980 compared to all these other assets? Real estate, the stock market, the U.S. Treasury bond, the money supply and currency. Well, they call it money supply, currency supply, and so on. And so what I did was I took the growth of the day in 1980 that silver peaked, and I took the percentage growth rate of all of those other things since that date, and I applied that percentage growth rate to the $52.50, and you come out with a total. And the average is over $900. And this guy that I am not supposed to mention said that, I can't remember what he called me. He said that triple-digit silver is cocaine-induced nonsense. So he's calling me a coke addict or something. And I absolutely believe that triple-digit silver is baked in the cake, that there is no possibility that we can go infinitely out into the future without triple-digit silver happening. It will happen one day. We have not yet exceeded our 1980 high. Is there anything else in society, other than computer chips maybe, which was a brand new technology, other than computer chips, is there anything else in society that is still selling at a discount to its 1980 price? I can't find anything except silver.
I make that point quite often myself. What's interesting is that there was a one-day, price is 50 plus. But if you look at the average price of silver for the year 1980, it was $20 an ounce. But if you go back 1 year ahead, the all-time high for silver in January of 1979 was $6 an ounce. So after the big run-up, when it resettled and found what I'll kindly call equilibrium, it was over 300% greater than the all-time high year before. Am I making sense? Because that's the truth.
Yeah,
and This is something that very few people know or discuss. But so if you took that $20 average for the year 1980 and did the same metrics, would that put us at $1,800 silver? So 20 is roughly half the price of 50?
I don't know. I just know that $50 is going to become support, but then it's going to blow way past that. And I don't think you're ever going to see it come down to $100 again. It'll probably settle at 150 or 200 or 300. I don't know. It may blow up to like $300 an ounce peak and then come back to 120 or something like that. Either way, it's a physical asset that you can hold in your hand that has no counterparty risk, that is destined for these big numbers. And I don't see that there's any way that this could not happen. I look for, how is it possible that they could keep this from happening with this constant growth of the currency supply? And now all of these emergencies that have been happening this century, all these things that come out of nowhere, like a diesel truck broadsiding us in an intersection. Lehman Brothers and COVID and war in Ukraine, and it goes on and on and on. And there will be a temporary rise, but then it comes back down. And I do feel, there is one chapter or one section on manipulation, and I do think that some of the manipulation is real, and people have been going to jail for some of it.
Sure,
that's mostly the short-term manipulations, where they're just stealing from the counterparty in the trade.
Yeah.
But the long-term manipulations, the comptroller of the currency just made JP Morgan disclose how much their short position really is, their position in the futures market. They were reporting under currency swap standards where you only have to report a small percentage. And they said, no, precious metals, you've got to disclose the whole thing. And so that chart just shows this sudden explosion. I'm sure you covered that
we've talked about it when the chart first came out. I want to talk about something.
Manipulation, though, is coming to an end, is my point. And once it stops, these big bullion banks are going to get on the long side with every, they'll convince the public to go short while they go long. So
perfect segue for my next question. So are you familiar with Scott Maynard by any chance? Scott was at Davos, now better known as the World Economic Forum, in 2020. And he's being interviewed by two financial guys from Bloomberg. And they asked him, what's your go-to investment? And he said, silver. And the guy just blew his mind. You could tell he just shit. What? Well, and he had a hard time composing himself. This is my take. And says, silver, well, what about gold? And he said, well, gold is pretty near its all-time high, but silver is off 60%. So in 2020, there was 320 million ounces of silver bought into the ETFs. And I suggest that Guggenheim, he was the chief investment officer of Guggenheim, probably had the lion's share of that. Now, I can't prove it. What I can prove is how much went in from the institutions. And that was the largest amount of silver ever in 1 year. The retail side on that year, Mike, was 200 million ounces. So if you add those two together, you come over 500 million ounces of silver for investment purposes only. So I said all that to say this. And maybe you put it in the book. I don't recall exactly, but what do you think when this run, what I call run to gold, which would be a huge spillover in silver, and silver will outperform gold, I'm convinced. Time will tell if I'm right. The people that are in the know, as you mentioned a moment ago, are not going to sit on the sidelines and say, oh, I'm going to watch my financial wherewithal crumble into nothingness in this fiat fiasco. I'm going to get in the bullion market as well. So where do you see the, let's say, institutional investor in all this?
Well, the institutional investors have a lot of power, and I believe that you'll be able to see the COMEX and so on will cater to them. But I do think the COMEX may potentially be headed for a default here. I think there's going to come a day where, there is a chapter on the book about a giant gold manipulation that happened during the pandemic. And I might be wrong there. Maybe my information is outdated, but suddenly in just a couple of months, the COMEX had to quadruple their gold stocks. And, everybody that's watching you knows that the COMEX is a fractional reserve scheme, that there's many, many times more paper ounces of gold and silver, promises to deliver, being bought and sold at any given moment than there is actual gold and silver to deliver upon. And they're now calculating their, they've got a registered category and an eligible, but they think that eligible category now is much, much smaller than they thought in the past, that a lot of people there may not, even though those bars qualify for inclusion in delivery, that the owners may not want to part with those bars at any price near what it's currently at. But these millions, I believe it was $55 billion worth of gold flowed onto the exchange in just a couple of months. And then somebody has taken delivery of about 12 million ounces, and there was 9.1 million ounces on the exchange before the inflows. So since the inflows, deliveries that have been taken exceed what was on the exchange. Now, during this time, the U.S., I'm sure, you get Nick Laird's information and stuff all the time too. Every month, month after month, for years and years and years, the U.S. is an exporter of gold. And one of the big places that we export to is the Swiss refineries. And during COVID, that reversed. We didn't export, we imported a lot of gold, and a lot of it was from the Swiss refineries. And simultaneously, China, who had been accumulating month after month after month for years without fail. There was more. When you look at all of this. This is just for your viewers. When you look at the central bank accumulation, they only report once in a while, and then it takes this big leap up because they haven't been telling us anything before. They keep it secret. But the Hong Kong exchange and the Shanghai exchange, we know the inflows and outflows. And there has been a net inflow into China every month for years and years. And then suddenly they stopped importing during the period of time when the US was importing. How does that happen? Is there somebody at these big bullion banks powerful enough to get China to actually stop importing gold for a few months while the US gets enough gold to stay out of some emergency default? Because I think that I haven't checked all of this like as deeply as I need to, because it requires somebody going through spreadsheets of inflows and outflows of all of the different countries around the world and trying to be an investigator and figure this out. And maybe Ronan Manley has already done it. He's a great analyst.
He is.
Yes. Yeah. I have a lot of respect for his writing. So if he has, I didn't read the article and with the final analysis of what was going on during those months.
The only thing I can add to that is that they broadened the definition of gold, because they were allowing like 400-ounce bars in what we call coin melt, which is not 999 fine. But any go, hey, this is gold. It's under that category during that time frame, which I found very interesting and telling that somebody somewhere wanted a lot of gold. Physical. Yeah,
well, all these conspiracy theories that there's tunnels between J.P. Morgan's vault and the Fed's vault. Right. They're at the same depth, and they're right across the street from each other. And coin melt would make all of the bars that were created from Roosevelt's nationalization of gold that used to be held at Fort Knox, that would make them eligible for COMEX. So it just feeds into all this conspiracy theory that we have absolutely no evidence for, but it is entertaining.
It is indeed. Well, Mike, I've enjoyed every minute of it. Is there anything that you would like to leave our viewers with before we sign off, in money, your book, philosophy, Puerto Rico, anything that comes to mind?
Well, I'd like everybody to learn as much as they can about the monetary system right now. I truly believe that we're in for something just gigantic, one of the hugest shifts in finance and monetary history is coming at us. One of the things that I say in there, as you know, fiat currencies have never survived. It's 100% failure rate. All of the fiat currencies that exist right now were born on August 15th of 1971 or later, because before that, all of the British pounds and all of the different currencies around the world were backed by gold through the US dollar. Right. So when Nixon severed the tie to gold, he changed the US dollar after August 15th was a completely different dollar than before August 15th, 1971. And if all the other world's currencies were backed by the US dollar, that means all of the other currencies became unbacked on that date. And so we're in this grand experiment that has never been done before, where all of the world's currencies are fiat currencies simultaneously. This is new territory. This is a monetary experiment that is conducted on a scale never before seen. And we know that every time this experiment was conducted in the past, that currency would eventually fail and people would rush to other currencies and to gold. Well, now there's no other currency to run to. There is only gold and silver, and that's it. So learn the difference between fiat currency and money, and then use the proper definitions. And this is something that I'm going to war on now. I'm the one that started this, but it surprised me that very few of my colleagues in this sector picked up on it and started differentiating between currency and money. And I believe it is important. In the book, I use a quote from Confucius that says, all knowledge begins with calling things by their proper names. And it is important. If we want to have truth and understanding, we have to call things by their proper names. And calling the US dollar money is giving it accolades it does not deserve. It does not store value. It steals value from you constantly. Every day and transfers a very, very tiny sliver of value to someone else, whoever got the new currency the Federal Reserve just created. Whoever gets that first and spends it, they get the full purchasing power. But as it circulates, it's going to cause prices to rise because we didn't inflate the dollar, we devalued we inflated the currency supply. We devalued the dollar by doing that. Lastly, go to ggsr21.com and it's for free. We're not going to try to get your email address at first. We're not going to, you don't have to give us anything to get chapters 3 and 4 of Great Gold and Silver Rush of the 21st Century. And there's going to be more posted there because I wanted this book to live beyond the original print date. And stuff is changing so fast that a lot of these charts that are in the book, you'll be able to go there and see the latest update, and then I'll be able to make comments on it and such. So those are the 3 things that I'd like to leave people with.
Great. So now we know the website to go to get chapter 3 and 4. Where do we get the book? I know it's on Amazon. Anywhere else?
It's on Amazon. It's on ggsr21.com.
Oh, okay.
So, yeah.
And don't forget to talk about goldsilver.com. You're one of the largest, most respected bullion dealers out there. And you and I met at Gold Rush 21 back in 2005, I think that was. By the way, Gold Rush 21 is sort of short for the Great Gold and Silver Rush of the 21st century. That's the reason they called it Gold Rush 21. But that was a conference where you and I went to breakfast one morning, and I had seen you for many years giving presentations on stage. And, I asked for your help I was going to become a bullion dealer. I was going to do some things and write a book. I'm not sure if you thought that I was actually going to accomplish the things I was saying, but you did, and I thank you very much. Well, it's mutual. I mean, I remember that very distinctly, and what sticks in my head was the conversation, the meal, But the fact that I got on that airplane to go home and sat next to John Embry, and all we yacked about is how much longer can this go on? And you were writing your letter to Robert Kiyosaki on that flight.
Yeah. That's what got me started and got me, that's where Robert Kiyosaki told me, write a book. And that was Guide to Investing in Gold and Silver. And now I believe that this book is even more important. And one of the important things, I left people with 3 things before. There's one more thing. The crisis of 2008 never ended. What we're destined for is the Bernanke bust. Everything that's going to happen in the next couple of years is Ben Bernanke's fault. He put all of these policies in place that Janet Yellen and Jerome Powell were sort of trapped in using, QE and all of these other things that Ben Bernanke had started. And that crisis never ended. We are in the eye of this gigantic hurricane. And the hurricane has picked up speed and power since the first portion of it passed. And we are about to go into the second half of this hurricane. And the winds are now off the charts. And I just hope that everybody protects themselves as much as possible from whatever is coming, because this is going to be something unlike anything in history. And people just will not know what direction to turn. And watch out for authorities that tell you that they know what to do. I mean, if you remember, Ben Bernanke was saying there's nothing wrong, everything's fine, no real estate problems. And a couple of days later, we see that Lehman Brothers has gone bankrupt. And the global financial system almost froze up. It came
very
within
close,
hours.
more than most people know. Yeah.
Right. And I mean, that means the gas doesn't come out of the pump.
That's right.
Once the global financial system freezes up, your credit cards don't work. A business can't wire currency into a bank. They can't pay people. Everything stops. And so we were just hours from that happening. And so when the experts are telling you everything is okay, or that they've got a plan, I wouldn't trust anything they say. I feel like I'm on my own, you're on your own. Prepare for it, do as best you can. Don't be scared, be prepared. And this may end up turning out to be one of the best things that ever happened to you financially. I just worry about what the world is going to look like after this event.
Yeah. Well, we'll leave it there. I might invite you back. I will have you back, of course. I don't know if beyond this book. You did a great job. I appreciate all you've done for the community. I really, can't think of anybody that's given up, let's say, their personal assets to put the money back in the education. And you've done that. And that's important. I mean, one of my purposes is to spread the word and educate people as well, because without knowing what we talk about constantly, most people just believe that unit, that fractional reserve accounting unit denomination has value. So I'll leave it there, Mike. Thank you so much.
It's all imaginary. I want to thank you, David, for having me. This was great.